Hello everyone, and welcome back to our ACCA Financial Reporting Lecture Series. Today we are deep diving into one of the most critical, highly tested standards in your FR syllabus. Chapter 4 Property, Plant and Equipment governed by IAS 16. In this comprehensive masterclass, we will break down the essential concepts of initial recognition, allowable costs, subsequent measurement, depreciation mechanics, and revaluation models. Make sure you have your calculator and notepad ready, because we are going to look at exactly how this will be tested in your exam. Let's get started. Before we look at any numbers, we must understand the boundaries of this standard. Let's first clarify what actually falls within the definition of property, plant and equipment under IAS 16, and more importantly, what is excluded from its scope. Under IAS 16, property, plant and equipment are defined as tangible assets. To qualify as PPE, they must meet two essential characteristics. First, they must be held for use in the production or supply of goods or services, for rental to others, or for administrative purposes. In other words, they are active operational assets, not passive investments. Second, they must be expected to be used during more than one accounting period, meaning they are non-current assets. However, be very careful in the exam. Not all tangible assets are accounted for under IAS 16. There are three key exclusions. First, any non-current assets classified as held for sale are handled under IFRS 5. Second, biological assets related to agricultural activity are under IAS 41. And third, mineral rights and reserves are covered under IFRS 6. Always verify the asset's function before applying IAS 16 rules. Once we establish that an item falls under the PPE definition, when do we actually record it on our statement of financial position? To recognize an asset, it must satisfy both recognition criteria on day one. First, it must be probable that future economic benefits associated with the item will flow to the entity. This means you have clear control of the asset and can expect cash inflows or operational cost savings. Second, the cost of the item must be measured reliably. For external purchases, invoice agreements serve as proof. For self-constructed assets, you must have robust internal costing systems for labor and materials. Here is a crucial exam tip. If an item fails either of these criteria, you cannot capitalize it. The entire expenditure must be recognized immediately as an expense in the statement of profit or loss. At initial recognition, IAS 16 mandates that PPE must be measured at cost. The total capitalized cost is made up of three distinct components. First, the purchase cost. This includes the purchase price, import duties, and non-refundable taxes after deducting any trade discounts and rebates. Second, directly attributable costs. These are any expenses necessary to bring the asset to the location and condition needed for it to operate in the manner intended by management. This includes delivery, installation, site preparation, professional fees like architects, and testing costs, net of any sales proceeds from test runs. Third, the site restoration and dismantling provision. This represents the present value of the unavoidable cost of dismantling the asset and restoring the site at the end of its useful life. Now, let's talk about what you are absolutely forbidden from capitalizing. The examiner loves to throw these into a list to trick you. First, administrative and general overheads must be expensed as incurred. They are not directly attributable to the specific asset. Second, staff training costs. Even though you are training staff to use the new machinery, you must write this off to P&L. Under IAS 38, you do not control your staff because they can quit, so training cannot be capitalized as an asset. Third, costs of opening a new facility, relocating operations, or product advertising must be written off. Fourth, any abnormal wastage, excessive labor errors, or initial operating losses incurred while ramping up production cannot be capitalized. They are straight expenses. Let's look at a highly tested quantitative topic, site restoration provisions. If a company must clear a site in, say, 10 years, IAS 16 and IAS 37 require us to estimate that future cost and discount it back to its present value on day one. On day one, you debit PPE and credit decommissioning provision with this discounted present value. The formula to find the present value is shown on screen. Then, At each year end, because we are moving 1 year closer to the settlement date, we must unwind this discount. We do this by calculating the interest on the carrying amount of the provision at our discount rate. The double entry is Dr. Finance cost in the P&L and CR the decommissioning provision on the statement of financial position. This ensures the liability gradually grows to its full settlement value by year 10. After initial recognition, IAS 16 allows entities to choose between two measurement models. This choice must be applied to an entire class of assets to prevent companies from cherry-picking which assets to revalue. Under the cost model, the asset is carried at its historical cost, less any accumulated depreciation and accumulated impairment losses. This is the default, highly objective model. Under the revaluation model, the asset is carried at its fair value at the date of revaluation, less any subsequent accumulated depreciation and impairment. Revaluations must be kept sufficiently regular so that the carrying amount does not differ materially from its fair value at the reporting date. Now, let's talk about allocation of cost. First, componentization. IAS 16 requires that if an asset has multiple significant components with different useful lives, each component must be depreciated separately. Take an aircraft as a classic example. The fuselage might last 20 years, but the engines only last 8, and the cabin interior must be replaced every 5 years. You must divide the cost and depreciate each part over its respective useful life. Second, depreciation is a systematic allocation, not a valuation. Useful lives and depreciation methods are accounting estimates under IAS 8. You must review these at every year end. If your estimates change, you apply the change prospectively. You do not adjust past depreciation. You simply take the remaining carrying value and divide it over the new remaining useful life. Let's master the accounting entries for revaluations, which is a favorite topic in both Section B and Section C of the FR exam. If you have a revaluation gain, the increase is credited to other comprehensive income or OCI and accumulated in equity under the revaluation surplus reserve. If you have a revaluation loss, the decrease is expensed directly in the profit or loss statement. However, watch out for the reversal exception. If you are revaluing an asset upward, but that specific asset suffered a revaluation loss in the past that went to the P&L, you must credit this new gain to the P&L first to reverse the historic loss. Any excess gain then goes to OCI. The opposite applies to a loss that reverses a previous gain, debit the revaluation surplus in OCI first, and send any excess loss to the P&L. When an asset is revalued upward, its annual depreciation charge increases. This means our P&L is being charged with excess depreciation compared to historical cost. To correct this, IAS 16 allows but does not require an annual transfer of this excess depreciation from the revaluation surplus directly to retained earnings. This is a direct equity transfer in the statement of changes in equity, meaning it never touches the profit or loss statement. Finally, when a revalued asset is disposed of or scrapped, we must de-recognize the asset. We debit cash and accumulated depreciation, credit the asset cost or revalued amount, and record any net gain or loss in the P&L. If any revaluation surplus remains for that asset, we transfer the entire balance directly to retained earnings within equity. That brings us to the end of Chapter 4 on Property, Plant and Equipment under IAS 16. If you have any technical questions, calculations that are tripping you up, or past paper scenarios you'd like me to address, please leave them in the comments section below. Don't forget to hit that subscribe button, turn on notifications for more ACCA video lectures, and download the PDF guide in the description. Thank you for watching, and I will see you in the next chapter.